Hey, what is up guys? Today is going to be quite interesting video. Currently, we are in the longest bull market in the history. No, I'm not talking about cryptocurrency market, I'm talking about stock market. In this video, I will take you 100 years back and I will analyze historical price movement of S&P 500 all the way to the present day. More specifically, I will talk about some of the biggest events that have happened in the stock market history, how cheap or expensive the stock market is, and what can we learn from 100 years of data in stock market. I divided 100 years of data into 5 parts. Each part contains of approximately 20 years of data. We are going to start in consecutive order, obviously, from the deepest past to the current date. First and foremost, before I start, I would like to define some terms that measures how cheap or expensive S&P 500 is and was. We are going to use price to earning ratio, or in short, PE ratio. Those of you who do not know what PE ratio is, the best way of explaining is to give you a simple analogy. Suppose that company's market cap is $1 million US dollars. The company's earnings annually is 100,000 annually. Therefore, 1 million divided by 100,000 equals to 10, or PE ratio is 10. But if company's market cap is $2 million with the same net income of $100,000, therefore PE ratio would be 20. On the flip side, if company has $500,000 market cap and earns the same amount of money, 100,000, therefore PE ratio would be 5. This is not a rocket science to understand that the lower PE ratio, higher the profit, and vice versa. The higher PE ratio, the lower the profit. The S&P 500 contains 500 largest companies in the United States, some of which makes more profits than others. The weighted average of 500 companies with the PE ratio will show how cheap or expensive the whole market is. Going all the way back to 1917, one share of S&P 500 you could have bought for around $10. PE ratio of the market was around 6.3, which is pretty good. It would be equivalent to 15% earning yield. There was some volatility and there was some declines of around 10 to 15%. Those are called corrections. From 1917 until 1929, market increased from low $10 to $34. That would be 240% increased. PE ratio also increased unsurprisingly from 6.3 to 18, but it made market quite expensive and it would reduce your earning yields. Unsurprisingly, this is when market experienced the biggest decline in the history. It is still the biggest decline to the current date. On the Black Tuesday, 1929, market dropped from $34 all the way to $4. That's insane. Almost 90% drop in the market. PE ratio dropped to low 13. The entire economy collapsed. The Great Depression began. Banks started closing down. People were not able to withdraw any funds that they had. Some of them start jumping out of the windows and killing themselves. After 3 years of bear market, economy began to recover slowly, going from $4 per share in 1932 all the way to $16 in 1937. That would be 300% increase. Since then, everything went downhill once again, mainly because disturbing events were happening around the world, led to the World War II, which began in 1939. Hitler invaded Czechoslovakia and war began. Market dropped from $16 all the way to $10. Not as bad as previous drop, but still 40% decline. Stock market continued to decline until 1942. This is when Pearl Harbor was attacked by Japanese. After this disturbing event, market had some small rally until 1946. It increased from $9 to $18. That's a 100% increase. At that time, no one really thought that this is possible. Market would increase during the second half of the World War II, which is quite astonishing. It had some corrections and moved sideways for almost 5 years until it gained more momentum. From 1948, trading for around $18, it increased all the way to $50 at 1956. That would be 180% increase. While violent events continued to happen around the world, such as USSR exploded first atomic bomb in 1949 and Korean War in early 1950s, stock market was sensitive to those events, but it continued to go up and up and up. With the stock market rally, PE ratio increased as well, from 7 in 1950 all the way to 13 in 1956, which means stocks were cheap in 1950s and became more expensive in 1956. Since 1956, we had an upward trend with some correction on the way. Market decreased by 10 to 15% 3 times or so, but in general it increased from $40 at 1958 all the way to $120 at 1973. That would be 200% increase. Some experts believe, such as Peter Schiff, that it was the biggest and dumbest mistake to do in the stock market history. You're welcome, Peter Schiff, for free publicity. Because of the skyrocketing inflation which would drop US dollar purchasing power, while others believes that he did the right thing to scale US and global economy with proper trading methods. Nevertheless, when Nixon resigned, market dropped from $120 all the way to $60. That's another bear market and 50% decline which happened in 1975. The PE ratio also dropped from 18 at 1973 all the way to 8 at 1975. 2 years later, market quickly bounced back to around $100 range and PE ratio increased into mid-11. Since then, we entered into the biggest bull market in the history. Well, at least at that time. Market increased from $100 all the way to $350 at 1987. That would be 250% increase. But not everything looked so great. Black Monday, October 19, 1987. Stock market around the world crashed. The crash began in Hong Kong and spread to West Europe, hitting United States after other markets had already sustained significant declines. Stock market dropped more than 22% in a single day. This is the biggest decline of a single day in the stock market history. After a dark night, there is a bright day after that. Stock market recovered and continued to rally. By the end of 1998, it increased all the way to $1,200. Going from $100 all the way to $1,200 in 2 decades, that would be 1,100% return on your investment. Despite the Black Monday, it was definitely the smoothest rally in the stock market history until that date. The PE ratio also increased from 1978, which was at 8, and it reached 25 at 1998, which means the stock market was quite expensive or very expensive. Let's move on to probably the most familiar and most memorable 2 decades in our lives. Well, at least in my life. Why most memorable? Because of recency bias? Well, maybe. Or maybe because I'm not that old. Well, at least I'm not. At 2000's PE ratio was at freaking 46. That's definitely the highest PE ratio we have ever seen in the history. It was this expensive for a reason, and the reason was a dot-com bubble in early 2000s. Market dropped from $1,500 to about $800. That would be almost 50% decline. PE ratio dropped from 46 all the way to 20s. Since 2003, market slightly recovered and increased back to $1,500 in early 2008. That's almost 100% increase. In that time, literally anybody could have received a mortgage on a house, even if you're broke and you cannot afford it. Even your dog could have received a mortgage loan. Banks were gathering those shit subprime mortgages into a bond and selling them immediately to other banks, mostly outside of United States. So they transferred their liability to someone else's instantly, while they are able to keep the balance sheet clean. They thought that they discovered a perfect way to make money without risk, until those bonds full of subprime mortgages add up and other party was not able to pay those liabilities, and everything eventually collapsed. Banks were not the only parties to blame. Another whistleblowers responsible for all that chaos that happened in 2008 are credit rating agencies such as Moody's and S&P. They gave AAA ratings to shit bonds full of subprime mortgages that were not even triple Cs. After the housing bubble crashed, they simply stated, "Our ratings is just our opinions." Oh well, I guess nobody will believe you this time. PE ratio was at staggering high. It was more than 70. Are you freaking kidding me? Was this even possible? And of course, stock market crashed. It dropped from $1,500 all the way to $750. That would be 50% drop. PE ratio dropped as well to 20s. Since then, we had smooth ride until the current date. Stock market increased by 250% since early 2000s. Current PE ratio of S&P 500 is 22. Makes it S&P 500 quite expensive, at least in my opinion. That's slight less than 5% earning yield. Not too sure if you are satisfied with 5%, but definitely not me. So, the question of the day, what did we learn from 100 years of history in the stock market? Please leave your comment in the section below, but I'm going to state my 4 principles that I have learned from that data. Number 1. It is probably not the best idea to enter into the market when PE ratio is very high. Personally, I would not enter into the market if PE ratio is more than 20. However, if you are a long-term holder, it would be a mistake to leave the market regardless how high PE is. Number 2. Market is an incredible compounding machine. An average compounding rate is approximately 10% per year. If you would invest $10,000 into S&P 500 100 years ago, hopefully you are not that old, now you would have $2.7 million US. Number 3. Market goes down sometimes, but it always comes back. We have been through many different wars and crises, and there was never a time when market did not come back. Number 4. Market is volatile. After 100 years we had around 50 corrections of 10 to 15%. That means that on average we can expect market to decline 10 to 15% every 2 years. Out of those 50 corrections, 15 of them decline 30% or more. Those are known as a bear market. We should expect bear market every 6 to 7 years on average. All those principles described above are facts, and if you want to be successful in the stock market, you have to know how to deal with them. My advice would be is to ignore completely the market and look for undervalued companies however you define value. In my book, value has nothing to do with the price to book value or price to sales ratio. You have to figure it out what it costs, pay a lot less, leaving a decent margin of safety. This is the end. I hope you enjoyed this analysis of S&P 500. It took me quite some time to create this video. Let me know what you guys think about this analysis in the comment section below. If you enjoyed this video, hit that like button. And if you're new to this channel, do not forget to subscribe for more animated videos about financial market and cryptocurrency. Other than that, thank you for watching and see you next video.